Good evening once again. And today's session is investment management. Basically, during the last 9 sessions, we have seen different topics. We have covered different topics, starting from basics of financial education to estate planning, to college education, to retirement planning, social security, and healthcare in retirement, as well as passive investment opportunities last week. So I hope these sessions have been very useful, and today's session is investment management. What do I mean by that? Basically, we are doing different activities to build our wealth, and they are across different asset classes. And as time passes, their the valuations or the risk profiles, they change. So how do we manage this? What kind of precautions do we need to take, and how do we overall have a balanced approach? So let's see. I have a few points, a few ideas to share tonight, and then it will be open forum discussion. You can ask questions and you can throw some ideas. So all of you are by now familiar. This is me, Chandrasekhar Azad, doing this to educate and basically share the knowledge. I live in San Ramon. My wife and 2 kids, and my passion is financial matters, investments, and I'm a realtor along with offering financial services. Now, investment management. So what are the different kinds of assets we own, and how do we protect them over a period of time? So broadly, every one of us, we are aware of these are the basic assets that we own, essentially in real estate and financial assets. Those are the 2 broad categories, if you will. So in real estate, what do we have? We have different categories again: the land, single family homes, multi-unit or multi-family homes, commercial real estate, and all. Financial assets, different classes again. Retirement specific, which we are all aware, if you are lucky enough to have pension, we have pension. There's not much to manage. Thankfully, that is managed by the government or the individual companies. Unfortunately, pensions have almost disappeared. So almost all of us are expected to be financial professionals planning for a long retirement, which takes us to the areas of managing effectively 401ks, IRAs, Roth IRAs, and different kinds of retirement accounts, SEP IRA, Simple IRA, etc. And then we also need to build wealth across the spectrum. I always call anybody's wealth is like a pie chart. We need to ensure that our wealth is in different segments. Why do I say that? Why can't I just have entire money in my brokerage investments? Yeah, you can, but if there is a meltdown like the Great Depression or 2000 dot-com burst or 2008, the great real estate induced crash, and you are retiring at that point in time, then you are stuck with that. If you withdraw all that money for the next 3-4 years, the market doesn't come back, then it causes irreparable damage. So needless to say, we need to have a balanced approach, and that is when we should not be touching our investment accounts. We should be having alternate fallback mechanisms. So that is what is important about having a pie chart. Like, what are the different segments? I talk about it in different. Essentially, all of us, mostly, if you are contributing, working and contributing over a period of time, you will have Social Security. Initially, Social Security was supposed to be the lion's share. In addition to the pension, Social Security was supposed to be taking care of our needs in retirement. There was a full 1-hour session wherein different aspects of Social Security and its history, how it is going and what needs to happen. How do we ensure that what kind of things that we need to pay attention when we are claiming Social Security was covered in that. But I will touch briefly in today's session as well. But when Social Security was introduced, basically the age of people generally was around 67, 68, or maybe into 70s. So they have uh, allowed Social Security be basically what do you call applied for, eligible for at 62, and then you can maybe next 5, 10 years. But in the last few decades, the life expectancy has gone up dramatically, and today people are living longer and longer. As a result, the amount of money that is contributed by Social Security is not enough. Also, in addition to that, you have other factors like the inflation part of it and the number of people contributing into Social Security, all those things. Right now, Social Security is expected to the fund is expected to last till 2035. But afterwards, what does that mean? Only people who are contributing in will be that money will have to be paid. So bottom line is, from a lion's share, it has come to a minor share of 10-15% probably, or maybe a little more depending on what kind of financial situation you are, what kind of income brackets you are. Then we come to retirement accounts. There right now, that is the lion's share. So that is where it is very, very important that we manage those accounts, build those accounts for a period of time. We'll cover that in a bit. That includes 401ks, Roth, regular IRAs, as well as simple SEP IRAs and all. Then the other segment is your investment accounts in the brokerage. And the next segment is your real estate. And then you have the tax advantaged segment to build your wealth. And finally, when you covered all these segments, the one segment you need to pay attention is to get some kind of a fixed paycheck or pension check, and that is by instruments like annuities and all. So that is a pie chart what we are talking about. So we need to have a proper distribution, and we need to manage each and every segment properly over a long period of our lives, so that we build not only solid portfolios in each section, but we also know how to manage them and when to leverage each one of them as we go along. Now, before we go into the each what do you call individual topics, but we need to know there are a couple of basics. The key to the lasting wealth is risk control, risk management. During our entire lifetimes, it's always the way we manage the risk. We either are totally avoid it, we manage it, mitigate it, or we transfer it. So risk control is the key part of it. And especially when it comes to the wealth building, that is what it is. So let's see what are the different strategies that are available that we need to automatically in autopilot, what do you call, paying attention to for our portfolios. So one, diversification, we talked about it, and asset allocation, different what do you call assets in different sectors, different segments, different geographic sections, different companies and all. And then asset rebalancing, we'll talk about it. We should be doing that at least once a year. And dollar cost averaging, these are some of the strategies that we do to manage the risk and acquire what do you call great wealth. Value investing and professional tactical money management. A lot of times we depend on what do you call, we do ourselves, a lot of vast majority of people. The greatest disadvantage there is the emotional behavior of it. I will cover that in a different slide. And leveraging the financial programs, what kind of different programs that IRS offers to build wealth and all. Some of them are annuities, index linked programs, and also how do we protect in when the markets are going down. There's different strategies. For example, buying a put protection is one of them, and cash positions. Overall risk management, you need to be able to have what do you call a proper cash management as well. If you are over leveraged without any cash, especially when the tough times come, then you are putting entire your or what do you call assets at risk. This is where I teach my kids, and in fact, the most popular game, what do you call when Monopoly, when we play that, lot of times kids like they are super excited about acquiring these additional properties and building hotels and all, over leveraging, and when money is not there, suddenly they have to pay. You know how it works. That property has to be mortgaged. It won't be generating income, and there may be a time that you may have to do a distress sale. We have seen that uh, very closely, very familiar in 2008 crash and all. uh, so when we are talking about cash position and how to invest and all, timing the market can be a tricky business. And of course, sufficient life protection, that is one of the fundamental things about risk management. And risk management is key to wealth building, and that managing overall investments part of it. Now, we'll cover quickly a few of these, and then we go about how do we individually manage. Now, diversification. What do I mean by diversification? Diversification means my asset is not in one location, not in one asset class, or not in one company. So I'm not just holding a real estate just in Bay Area, or I'm not holding entire my wealth just in a stock like Amazon or Apple or what do you call Tesla. Uh, just to give you today's absolute winners can be tomorrow, can just disappear like that. Just less than 10 years ago, the largest, biggest, absolutely wealthy company is ExxonMobil by market cap and all. Today it is nowhere. It is somewhere in the mid, somewhere after 50 or 100 companies. How did it disappear in 10 years? Before that, we know what happened to Kodak. So today's absolute untouchable winners can tomorrow, if there is a technology change, if there can be a seismic change by way of technologies, the way that technology develops and all, can what do you call affect our wealth. That's where it is important that we build our wealth in across different companies, across different industries, and across different regions. That's what I talk about. Different industries means now, so just 10 years back, oil industry was absolutely unquestioned. Nobody was talking about. Today is technology. Technology, again, different sectors. Uh, till a couple of years back, these huge ERP companies, now suddenly they're falling behind the new technology, the cloud-based part of it. And who knows tomorrow what comes. So that's where we need to pay attention. This diversification across different regions and all. Now, its simple analogy is this. If your lift is having one single cable, it can snap and go. If you have enough proper diversification, if that company goes belly up, you have other companies, other portfolios, other asset classes. Take 2008, for example. I know a lot of people who made real good, big money into real estate portfolios, extended, over leveraged. Basically, how do you buy a home, you take the equity out of it, use that equity as a down payment for another home. Market is going up, again you do the repeat the process. At certain point in time, you are actually having a huge portfolio. As long as market is going one direction, no problem. Once there is a problem, there is a few what do you call bad tenants, or something goes wrong, you can't pay, and then you know what happens. So not just in real estate, but you need to have different asset classes. Portfolio rebalancing. It is a tricky thing, but at the same time, it is also what do you call recommended thing. The pundits are basically some of these, when the markets are going up, keep the winners, they say. But at the same time, you also have to do the rebalancing. So you need to have a fine judgment. Yes, if your assets like the latest, whatever the winners are winning, keep them. But at the same time, you need to know your risk taking ability, and should there be a change, what happens. So that's where this asset rebalancing is recommended for a long-term health of your portfolio. Let's put it that way. It is also needed based on your age. When we are young in 20s, 30s, 40s, probably we can take much bigger risk because the time is on our side. The markets, even if they go down, they can come back, whether they are individual stocks or whether they are what do you call indexes, related funds or mutual funds, they can come back. But as we are going into nearing the retirement age, probably you may want to have certain amount of portfolio in your debt instruments. That is what we are talking about here. Now, what is the dollar cost averaging? We talked about, so this is again one of the investment strategies. What am I doing in what do you call investment management? They are all interrelated, interlinked. So I would cover this a little bit. What is dollar cost averaging? Most of us are already aware of it. You have to essentially identify to own absolutely solid assets, the good companies. Sometimes as they are going up, you probably think, okay, you may want to pause or you can continue to acquire. But when the market comes down, if this is a solid good company on solid good asset class, you think you have the bandwidth, you go acquire it more, but do it in a what do you call step-by-step process. So when, for example, a unit of it, say for example, here is an example, a cow story. If, as we know, the asset class cows is not going to go anywhere. We do need milk. We do need for any number of reasons, right? Um, so if you believe in that asset class, if you believe in that company, if you believe that you acquire one cow at $100, the cost goes down to 50. Do you sell it panicking, or because you believe in that you acquire? You are assign the same amount of investment capital, you can acquire two at the when it is 50. You know the story. As it goes down, if you have the inherent faith, be careful here without chasing those dot-com bubble kind of mania or the fly-by-night companies, or some of these marijuana or some of these exotic companies wherein you chase, keep adding. It's a losing proposition. So the key is essential strength is what do you call should be ensured. That is absolutely good, healthy blue chip companies. Now that's what we are talking about here. So when you do that, you are not going to lose it anywhere. Uh, Inevitably, they will have to come back, and when they come back, because your cost of acquisition is so low, your what do you call you profit immensely when the market starts rebounding. So this is what it is. Over a period of time, you acquire all the way and allocating same amount of investment capital. And when the market goes up a little bit, not at 100, but just 50, your gains are magical. Now, value investing, same story, a little more different. You are doubling your investments so that your cost acquisition is much, much lower. So you get much higher returns. Again, the key here, time and again, we need to remember is ensuring that the asset, whether it is real estate or whether it is these companies, you have to ensure they're solid, good investments for a long period of time, not just in a short time frame. Now, investment behavior, essentially, we talk about a little bit of this. Important to know how you manage your risk. How do you manage your investments? Why do I show this? This is essentially what do you call signifies the behavior of the individual investors. Over a long period of time, this is how the different asset classes have what do you call given returns. But you see the average investor just got about 2.29. Why is that? Nowadays, every kind of information is available at our fingertips and on the internet, on your brokerage firm, you name it. There is no excuse, not like 20, 30 years back where we didn't have the information, we had to depend on pundits. Now, even though everybody has, in fact, on your cell phone with Robinhood, and nowadays they are actually driving the market, but still average investors return over a period of time is 2.29. Why is that? because we are emotional creatures. As long as it is going is good, good. But when it is coming down, we tend to panic. When it is going up, you may just cash out very quickly. When it is coming down, you may wait too long thinking that it may come back and sell it absolutely very bad time. This is what it is, the difference between professional management and individual sellers. See this here, as long it is going up, you wait, thinking, okay, it will come back. And when it is absolutely at the peak, a FOMO hits, fear of missing out, and then you buy. Somehow magically, you think that only when you buy it, the market starts coming down. You wait, thinking that it will come back. Wait all the way until it falls so badly that you do not have the capacity to withhold, because you can't see the trade anymore in your statements, in your, when you open your account. And then you decide, okay, it's not good and good for me, it's not, I sell it, only to see that markets magically come back after the, this is a classic individual investor behavior. Okay, so that's where they have all kinds of what do you call sayings. Bulls make money, bears make money, the pigs get slaughtered. Or individually, this is what it is, right? You wait until it is too late to buy, you wait until it is too late to sell. Now that is where it helps to have a professional management, or give it off what do you call, to the index funds, or assign it. You don't worry about individually managing it, let professionals do. And even if the markets do come, they fall, they do come back. Now that is essentially what I wanted to talk about from the point of risk management for especially investment in stock market or otherwise. We need to manage the risk. Now let us go ahead and see how do we individually manage different asset classes. What are the things that we need to pay attention to? Now, we know that different asset classes, real estate is one of them. And in the real estate, what do we have? We have land, we have what do you call, residential properties, we have commercial properties. The first, land. A lot of us, whether it is in US or whether it's in India or anywhere else, we like, a lot of people like land. If it is affordable, if you can lay hands, please buy it. They, of course, pay attention to what kind of zoning that is. Are you buying a farmland? If so, do you know what to do with it? Are you planning to do yourself farming, or are you planning to give it for rent, lease? So what kind of laws are there? What kind of income that can be generated? Is there a tax benefit there, or are you going to pay taxes on it? So those are the different things we need to pay attention to. As far as land is concerned, if you have good land where it is coming at an affordable, good price, not the hyped up price at different times and different locations, buy it. Land is the only asset class which people are, nobody is making anymore. You may, any other asset class, you name it, we can make it, but not the land. So I'm a big believer in acquisition of land if one can, what do you call, put sides. So when you buy it, ensure that you don't pay these hyped up prices. There are different, as I said, the different examples of something coming up, a capital city is coming up, or an industry is coming up, prices jack up. Do your due diligence, research, buy only without any hype. Then ensure the title. US, no problem, you have the title companies and all, but if you are buying in any other country, especially, we know that from the experience, different locations, ensuring a good title is important. Do the due diligence. So who is selling it? Have you done the link documents, or proper title research and all? Ensure that you have a clear title. And once you acquire the land, whether it is here or anywhere else, who is going to manage it? Do you have the bandwidth to manage it? Is the land accessible to you by travel? It's in the same city, or do you need to go somewhere else? If you are not able to manage yourself, who is going to manage it? Are you going to get money from rent, or are you going to pay somebody to manage it? So those are the things you need to pay attention to before we acquire the land. Um, a little bit of my own information. Did acquire good amount of land back in India when we came here in the early days. One of the best investments, I can say that. But as we started settling down here, as time has passed, parents are here. So managing those lands is a huge deal. Now we have relatives, but how long you want to trouble them? Are they willing to take that risk? And if they're not there, how do you do it? Protecting those lands from encumbrances is one more difficult task. So you have to pay attention to all those things. Have a time frame. When are you acquiring? What is your time frame? What is your appreciation you're looking for it? And do you have a proper plan? Who is going to manage it? You are going to settle down here thinking somebody else will manage. You may be in for surprise. There were a couple of small pieces of land we had to let go because we are not there in the location, and somebody else was supposedly, what do you call, occupied. That is not unheard of it. So here we may be a little more, but anywhere it is important to have a proper plan and uh, put it in writing saying this is my plan of acquisition, plan of how long I want to keep it. These are the people who will be managing it, whether I'm paying for it. This is a cost of maintenance management, or this is the income. And once I have an appreciation of 10%, 100%, 1,000%, whatever that is, I'm going to liquidate it. No, this is forever. I'm going to keep it. If so, how do I manage it? Pay attention to all those. Nowadays, there are professional services companies which are doing it. So that is something worth considering. And also proper protection, whether here or anywhere, what do you call, having proper fencing, demarcation is very, very important. Then comes to what do you call, properties, residential or commercial. One of the most important things that anybody who comes here is we need to immediately acquire primary property because government is big on it. The encouragement to save for future, giving what do you call, tax benefits in terms of mortgage taxes as well as property taxes and all. Even though there are limitations now in place for both east and west coast at $10,000 property taxes, it is still worth because instead of paying for your rent, you are paying yourself, building your equity and getting all the tax benefit. Once the primary home is out, you are essentially, we're talking about managing the investments. So primary home is the biggest investment, but at the same time it is given because you are there, no worries. Just pay attention that you are not over leveraging, especially now Bay Area market has become red hot. Thanks to the change in the, what do you call, work culture, work from home and all, it may make sense essentially to buy this because the trend is that way. But we do have to pay attention to the amount of money we are paying, as especially considering your capacity. As long as you're going to live in your primary home, and as long as you have the bandwidth, you're not trying to flip it in the next couple of years and all, you should be mostly fine. But if your time horizon is wrong, if there is no job security, if your status is in question, and those are the things you may want to think about it. So do due diligence, pay attention, and if you fit into this, do buy the primary home. That is the easiest investment you can manage because you are living there, you can take care of it. Next, rental and investment properties, whether it is single family homes or multi-family home, multi-unit home. Now, most preferred is the single family homes, and that too people have a tendency to prefer to buy it where it is easily accessible. But nowadays, in United States, anywhere across the country, it is not a problem as long as you are able to get good property. There are property management companies. You are not able to go in person. There are companies which can provide those services for 5 to 8% of what you call rental income and all. One thing again is ensure that we do not pay over too much of a price. Do not leverage. That is a mantra, do not leverage, because if the property is not getting rental income for 3 to 6 months, can you sustain it? Do you have the capacity to bleed for 6 months without rental income? You got to think those things. So if that is the case, you go ahead and uh, when you're buying the rental properties, what you need to ensure is, especially the single family home, the rental income should, to a great extent, I would say actually it should cover all your expenses. What are the PAT, your principal, interest, taxes, insurance, and if you are giving it for property management expenses. After all that, you should generate some income, whether it is $50, $100, $200, whatever. If you do not, then you better have sufficient bandwidth to manage and to fund that short the gap. So ensure that your rate of return is break even to positive cash flow. You need to ensure that. That is when we can acquire great wealth. Um, Even when the market comes down, as long as there is the income, rental income is coming up, that is where it is important to pay attention to where you are buying. Sometimes uh, uh, the areas where the properties are real cheap may be cheap because there's a reason for that. If there is not too much of employment potential, if the economies are not robust, then when the downturn comes, when the economy is in what you call deceleration, like then you are in danger of seeing vacant property without generating any income. So we need to keep those factors in mind. So Bay Area may be expensive, but maybe Bay Area is going up because there is a huge wealth building potential here. We have seen that. So what I'm talking about, you know that. So just don't go after the cheap properties. Keep in mind the what do you call economic potential, employment potential of those regions. Uh, what we're talking about is then we already talked about own management of versus property management. Again, if the property is accessible, you definitely can save that money, but you do have to keep in mind that calls can come middle of the night saying something broke or plumbing is not working and all. So you should be ready to take up those challenges. If most of the time, if we have home maintenance, what do you call insurance from American Home Shield, or there are multiple companies that are providing those services, home warranties, you are mostly protected. There's a monthly fees, and also there is what do you call a copay when there is a call made. But it is worth having those. Anybody having rental properties, if you're having those rental properties without this annual home warranties, then you are risking a couple of things. One is your peace of mind, and you may have to personally go and do it. Second is something breaking big can put a big hole in your entire planning. So, and think about that. Vis-a-vis property management, peace of mind. You don't need to worry about it. Somebody else is doing your work for a cost, 5 to 8%. Then comes the other, what do you call, multi-unit, multi-family, multi-unit investments. Nowadays, a lot of us are getting these different new projects from, if you are in the, what do you call, searched anywhere automatically, you will be getting this kind of, what do you call, proposals from your friends or otherwise on the internet based on the search. And they can be a great wealth builders, and it is in fact very well recommended. But then, are you going to go as what do we call, taking a small slice as a passive investor, and or do you have the capacity to do a entire, whether it is 5 unit, 10 unit, 20 units, entire deal? So think about it. If you do not have the capacity to do the whole thing, then you need to carefully analyze the project report put forward by the promoters. And here it's very important to ensure and validate, vet the promoter's profile. What kind of promoters are there? What kind of experience they have? Do they have the skin in the game? Or are they just, they acquired this property, putting it and getting their returns quickly and getting out, and afterwards they continue to maintain it and getting 5 to 8% of fees for maintenance? Is that, or they actually have the skin in the game? Should the project go wrong, they are also impacted. In fact, last week we had a great session where Srini was mentioning this very point. Ensure that the promoters have skin in the game, whether it is commercial ventures, what do you call, multifamily units, or anything. That is one of the your insurance to ensure this due diligence by the promoters. Then ROI, the cap rates, and timeline. And what is the timeline? Whether yours or the project per se. What kind of guarantee they are giving? Is it 4% cap rate, or is it much higher? Is it valid? And when we are talking about multifamily units, are they taking into consideration the what do you call, local unoccupancy rate? Are they showing 100% occupancy, or they're reasonable at about 80% or 90%? What kind of occupancy rates they're showing? And what is the divestment timeline? Okay, is it 5 years, 10 years? And what happens if the market is not in our favor? You need to know and have a thorough understanding of all this, and keep them, what do you call, do that homework before you. Once again, over leveraging is not recommended, and you have to have the capacity. Okay, they are promising 5% or 8%. And what happens if there are some micro project related issues? Suddenly they ran into some local compliance issue, or there are macro issues, like just like COVID right now. Out of the blue, nobody even imagined, across the globe, across the country, and what do you call, economic activity is impacted. So all those plans which people must have put in their project timelines, saying we are thinking about, we are very confident about completing this in about 24 months, 36 months, they go out of the window. So do you have the capacity to withstand? And are you dependent on that income, or it is just that an additional income, additional capacity you have, and when it comes, it comes? So that clarity is a must. Commercial venture, same thing. Last week we have seen, whether it's a hospitality industry, very specific examples. So explore, and if you have the bandwidth, go ahead, but do the due diligence. Now, financial other assets, real estate, those are the different assets that how we need to ensure, when what are the precautions we need to take, and how we can manage and all. Commercial multi-unit is, if you are not the primary promoter, somebody else is managing, so no worries for you, except the initial due diligence of evaluating the projects per se. Now, when it comes to financial assets, there are different asset classes, different assets under financial assets. Starting from Social Security, it's a financial asset, and then there are different assets which will. Social Security, again, I covered already different points, and we have attended that one session. Educate yourself. Attend to this kind of sessions wherein experts do come and speak about, so that gaining knowledge is over a period of time. It is not suddenly you wake up and you are 62 plus. Oh, by the way, I need to apply for what do you call, Social Security. You are 70, 65. Oh, by the way, I forgot to apply for Medicare. Okay, I should have done that 3 months before. So this acquisition of knowledge is over a period of time. We need to do that. And consider becoming a member of some of these organizations like AARP. They do a lot of education, free seminars, free educational dissemination, and also advising. They have what do you call, support services to help people navigate Social Security, Medicare, and the different aspects of it. So consider becoming member of one of those. Now, after Social Security, what are the other things? Retirement accounts. So retirement accounts, we need to build over a period of time. It doesn't happen one day, not suddenly when you are 5 years down the line, you are looking at retirement and then you realize that you do not have enough retirement portfolio or account. If you have pension, you are covered to an extent, but nowadays pensions are disappearing, are mostly disappeared except for government employees. So we need to do this when? At the earliest, the day we join, thanks to the change in the laws and all. Unlike in the olden days, 10 years back, now people are automatically enrolled for 401k contributions and all. So how much do you need to? I recommend go ahead and do the full. If you are not able to manage anywhere else, if you do not know how to invest and build wealth with that, at least do maximum. If you can't do that, at least ensure that you contribute the same amount that is given by matching contribution given by your employer. Do not ever leave that matching contribution from the employer. That is a free money on the table. Now, ensure that your 401k portfolio, how do you manage it? You need to be looking at it, if not on a daily basis. If you allocated those funds, you are not actively managing individual stocks or individual moving around. At least once in a couple of months, you should be looking at it. At least my recommendation is at least look at them once a week or once a month, depending on your profile, depending on how you. I know when I'm doing this, what do you call personal financial strategy sessions for individual families, whether you believe it or not, there are families where they have not looked at the 401k allocation, whatever. Okay, they have put it on autopilot, it's going on. They have no clue what it is doing. So don't be like that. Ensure that you look at nowadays, thanks to the internet and thanks to the hype, thanks to the way Robinhood and all, most people are actually doing over looking at looking into their accounts and doing over trading and all that. But then the point is made, right? Proper allocation is important. Reflecting your age, reflecting your knowledge, reflecting your risk-taking ability. Whether your company allows you to do individual stock trading or you have to choose from the set of funds that are provided. So if you have the ability to do that individual stock trading, you better acquire enough knowledge, have enough discipline, and do the trading only with a minor percentage of the amount rather than entire portfolio, unless you consider yourself as a absolute professional kind and you have your what do you call experience to back it up and your performance to back it up. Otherwise, select the funds which reflect your age and risk-taking ability. If you're young, there are retirement accounts, portfolios which say 2030, 2045, 2050 and all, depending on when you are going to retire. What do they do in those named, what do you call, with the year name and all? The experts are allocated the research, what do you call, the funds into what do you call the growth, the solid companies, blue chip companies, the what do you call debt instruments, securities, treasuries, and all that based on the what do you call anticipated risk taking profile. So if you select a fund which is into 2050 or 2060 or something like that, then your retirement is far into future. You can take more risk, so the money is allocated into the growth companies, small companies, or the large cap which have growth, and there is very little or negligible amount into the debt instruments. Whereas for people who are nearing retirement, if you select 2025 or 2030, those funds, there is much higher concentration of what do you call debt instruments basically compared to the stocks, right? Why? Because you get return and you are the volatility is much less. Then consider between index funds and actively managed funds. Again, if your portfolio, you should be able to see all those different kinds of funds that are given by the company. And each one of those, if you click on them, they give you the performance 6 months, 1 month, 6 months, 1 year, 10 years, 5 years, 10 years from the inception and all. You see how the performance is. And then you have the cost there, the fund cost, whether it is 0.05 for index funds, most of it because nobody is managing actively. They select all those the great companies that are performing and they put into that index reflecting the S&P and different indexes. So it is automatically based on that. Nobody is actively managing. That's why the costs are very little. A lot of people say, pundits say that it's very difficult over a very long period of time to beat the indexes. Okay, having said that, it doesn't hurt us if to take a look at these actively managed funds. Who is the fund manager? What kind of returns they have delivered? And is the cost 0.75%? Is it 1%? Is it 1.9%? Sometimes I have seen in these actively managed funds, the cost of the fund is as high as 2%. It's going to be killer. Why? Think about it. What that cost means is every year they are taking 2% of your entire portfolio, that fund port is going towards the fees. Year over year, when they take it out, it is going to be a huge, huge deal. Unless they are delivering that kind of absolute, what do you call, scintillating performance, beating maybe 5 times, 10 times the market. That is something which most people are cautioned against. High cost funds are to be stay away from them. Again, it's about individual risk taking ability and individuals. I liked the fund manager and I see that 15-20%. Okay, I don't mind giving the 2% as long as I'm getting the return. Okay. Basically pay attention to those and evaluate those funds with respect to your age, with respect to your risk taking ability. Annual rebalancing, we talked about it. That is to ensure proper risk management. And then individual stocks versus mutual and index funds, which we talked about it. Again, it's all about education, knowing your risk, what kind of reward, and most important, don't forget that slide which I showed, individual emotional behavior. When the market starts going down, do you have the discipline? That is very important. Then consider professional advice. That is where it is basically you take away what you call the emotional behavior. I know a couple of what you call a few people where when March 19th or March 23rd, I think, market started collapsing from February 19th at 29,951 to March around 18,900 or whatever that number. At absolute, what do you call, bottom, converted entire portfolio into cash, thinking that we don't know where it is going, only to see the market has done a V-shaped recovery. Nobody knows why it is going, whether it is blaming on Robin Hoods or blaming on SoftBank buying bullish bets of it, some $18-20 billion thereby driving the market. Nobody knows. But the bottom line is economy per se is not doing great other than the COVID-related work from home companies and the online trading companies online. Other than those, general economy is in a pretty bad shape, but see what it is. But bottom line is you sell at the lowest and you are not quick enough to jump back in and see what happens. And probably if somebody is jumping in now at Tesla at 2000 only to see it pulls back 30%, 40% again. Individual behavior, very, very dangerous part of it. So consider professional advice. And if you have your brokerage account with any of these big firms, whether it is Ameritrade or Franklin Templeton's or Fidelity's and all, or any of them, they have this what do you call investment advisors. I think to most people they are offering those services, but if your net worth is a little higher, they will actually call you. Otherwise, you may want to call and ask for advice. They will do that. But bottom line, what they do, this is their knowledge, they talk about it. They ask you a bunch of questions. They ask your risk-taking ability. They see your profile, how old your kids are, when you will be needing funds, when you will be retiring. Based on that, they'll say, okay, these are the funds you should be considering to invest. So consider that. Take initiative to find out about that. Then private wealth management firms, if you have, based on your net worth again, they may come after you. They may just keep giving you calls. The official guy, okay, what is that you can do? No, this is what we advise. Okay, can you guarantee? Then the first thing they say is, oh, you know that there are no such things as guarantees. Then what can you do? Okay, we'll help you navigate. So if you do not have the education, and you are too super busy, you have built enough wealth by way of your stocks or RSUs or whatever, then it is worth considering those private management firms. On this, we talked enough of it. Social security, one of the financial, instruments. I think we have covered most of it. Uh, from the point of managing the financial assets, you have to pay attention to getting that slice of guaranteed income part of it. So these are the fixed annuities and index annuities, variable annuities, some very powerful instrument that is there to generate, to give us a fixed income on a monthly basis as long as any one of the partners is alive. So that is what, with that, we come to the end of how to manage it. So what is the time looking like? It's almost about 1 hour. Cancel this and give me 1 second. Okay. Yep. I think I covered most of it. Let's go back to this slide. So coming back to, am I sharing? Okay. So coming back to the overall, the discipline part of it, ensure that we follow this financial foundation part of it without the proper protection and emergency fund. And then it comes to safety investments and then the risky investments. This overall is, we need to follow this. So with that, thought, I open up for any question answer sessions. Do we have any questions on YouTube or here?
Yes, I have one question here on the YouTube.
Okay.
Should we decide rent for a home based on principal and interest plus insurance plus property?
It's 9 o'clock.
Okay, what's the question? Should we consider?
Should we decide rent for a home based on the principal and interest plus insurance plus property taxes? Basically, how do you determine what should be the rent of a house?
Yeah, most of the time it should be the other way around, because where you are planning to buy, there the market decides what the rent is going to be. Unless, of course, the small variations can be any additional features and appeal of your home. So based on the rental profile and potential, you would be deciding what is the amount I can invest in the rental property so that my outgo, which is PITA plus property management expenses and all, will be less than the potential rent. So your question should be the other way around. You approach based on the potential rather than after buying it, assuming I bought the home. Okay, I put more money than say I put my outgo is about 3,500 per month. If I say I want the rent for that home 3,500 or 3,600, but the similar homes are available only for 2,800 or 2,700, do you think that anybody will come and rent your home? You will be sitting in the market, 1 month loss of rent. It will be difficult to cover the what do you call it? If it is $200-300 difference, it will take about a year to cover the gap of 1 month sitting on the what do you call empty without giving the rent. So your investment should be based on the rental potential, not the other way around. But if you have the demand and if you are already there, then you don't need to limit yourself just to give the what do you call give it for rent for less. Assuming your total outgo is maybe $2,000, but if your home has a potential to fetch $3,000, you don't need to price it at $2,200. So you know what?
Okay, I have one other question. Probably it depends upon the age factor of the individual and all that. At what age does one need to consider retirement as higher priority than non-retirement investment?
At what age retirement should be considered as a higher priority
over the non-retirement investments?
Okay, I'm a little confused. The question is based on the for the investments or the for when one should retire?
Let's say there is a 35-year-old individual who is an employed, who has a steady job and all that. So would retirement-based investment should be higher priority for him, or non-retirement-based investment should be higher priority?
Yes, basically based on the age, if you are able to build great wealth, automatically that helps you cover your retirement. The question probably I think guessing is, should I be investing more into my 401k or should I be focused on using those funds if I can build in the what do you call stock market or real estate? Probably I think that's where the question is pointing to. So as I said, if you think you have the bandwidth, knowledge, discipline, and capacity to build wealth outside, you very well should go ahead and do it after contributing the money that is needed to get companies matching funds. There are two things again. One more thing you need to pay attention is the what do you call tax benefit the government may be giving. If you are under 50, you can contribute up to 19,500 as an employee into your 401k or retirement accounts, right? And above 50, you can contribute another additional 6,500. Now, if you're young, I don't want to contribute 19,500 on what do you call trading stocks. I bought Teslas, I bought Amazons, I bought Apples. I'm making too much money there. Okay, good. So at least ensure that there is certain profile, certain portfolio. Do not put everything into this. What happens tomorrow? Suddenly there's a game changer on Teslas and whatever this talk come down, then you are totally exposed yourself, right? Have that percentage, that share of that income, I mean contribution in your retirement accounts, wherein that's all about balancing I talk about. So you do that. At least basics ensure to get the matching funds. It's very appealing in the days of these Robin Hoods and Tesla zooming to think that everybody is mastering the art of stock market investments. And I have seen enough, starting from the .com, there were companies, JDSU, for example, it shot up from, or pet.com, from nowhere, absolutely skyrocketing, $380. Nautils exploded from about a couple of dollars to about $85+ only to disappear. So please be aware, this bull market, what we have seen, will have its cycle. So have the discipline to have enough funds allocated to your retirement accounts, and go and do the investments. I'm not discouraging. One has to. I am in stock market, I'm in real estate. I love both of them, but at the same time, we need to ensure your retirement accounts are building over time. Okay, it is play with the what do you call it, the stock market with additional money. Too much of preaching, I suppose.
I think that answers the question.
Okay. Yep. I have a question here. I'm 50 years old. My current investment is only in 401k. Is it the right time to invest in others, annuity and others? Very, very beautiful question. So when I'm doing this personal financial strategy session, a lot of youngsters, they ask, okay, I want to go and invest in annuities. I normally tell them that wait until you are a little older. Why do I say that? Because there are better instruments when you are under 50. You can leverage tax advantage programs like IULs or stock market or retirement accounts, right? And including real estate. But once you are above 50, you are already looking into the future. You have maybe another 10, 15 years retirement based on your age. So you already accumulated certain wealth and kept certain cash in a liquid positions, which is sitting in idle in CDs and bank accounts, which is not doing any work. You should definitely consider that putting into annuities to get a guaranteed interest. I mean, pension in the retirement, as long as one person lives, two people live, based on what kind of annuitization one you can opt for. So again, depending on the risk part of it, there are people who say, "Oh, annuity giving me only 4 to 5% or 6%, I can make much more money." Then definitely it's not for you. But at the same time, those people also should consider the fact that it is guaranteed. It is not related with the variations, fluctuations in the market. So coming back to your question, if you have only one 401k, you still have about 15 years of active life. You should definitely consider an annuity, and also maybe a rental property. And you definitely need to consider them. Individually what we should be done and all, that is what I do a free I call personal financial strategy session. That is a couple of hours session. Take time. There are absolutely no strings attached. It is a pure one-on-one financial physicals, not health physicals. It's a financial physicals, wherein how you are doing, what kind of profile it is, and whether you are cruising along into your retirement, you have surplus income coming into the retirement, or you're falling short. What needs to happen? What are the steps you need to do when you do the trend analysis and see a gap? Or you have too much money coming in, and your major challenge would be managing the taxes. Are you building too much wealth in those portfolios where you'll be paying very high taxes? So those are the other sessions which we have. So take time, an hour or hour and a half, and have that session if you would like to. Or even if you don't want that, any specific questions related to, okay, how much should I invest in order to get, say, $1,000 or $2,000 by the time I'm 65, guaranteed in? Or so those kind of iterations, we can do that.
Any more questions? I don't think we have any more questions. So thank you, Azad. This has been a very informative webinars that we have been having for the last 2 months. We've been looking on for every Thursday night to have these classes. And since we started this, many of the folks that I have been interacting here with SAMASTI have really appreciated the level of information that they're getting on with these webinars. There is quite a bit of interest that some have expressed upon to have their own personal financial management evaluated and analyzed and seeking guidance. So I suggest that anyone who have the need, please reach out to Azad. He has the 2-hour free time that he can allocate for each session, and refer to SAMASTI, and he would be able to handle that. So there are some names that have explicitly asked for me, and Azad, I will send those names to you.
Okay. So once again, Leela Garu, thank you very much for taking initiative and organizing these sessions. It has been what do you call a very, very exciting experience sharing this knowledge, what I have, and also trying to have exchange of ideas and all. Once again, all of you who have attended, who have been here, and any of your other friends, you have any different ideas or different topics that we want you want it to be covered, please feel free to drop an email. You have my email right there, or my phone number. You can text, you can get in touch with Leela. And we plan to bring back some of these sessions or new sessions in future. We have other organizations that have approached us to do similar kind of sessions. So whenever they are there, if you're interested, we will be definitely sending you invite. Again, once again, thanks for taking time on Thursday evenings. It has been a fruitful journey. Hope to see you all sometime in the future again. Thank you. Have a great day. Great night. Good night.